Exchange-traded funds, or ETFs, have grown rapidly in recent years, first internationally and then also here in Australia, as investors have been attracted to their low cost, transparency and tax efficiency. At Implemented Portfolios, the portfolios we manage are predominantly constructed using exchange-traded funds. When the investment committee has agreed our long-term forecast and the dynamic asset allocation targets have been set, we use ETFs as efficient building blocks in constructing your portfolio. So what are ETFs? Well, firstly, as the name gives away, they're exchange-traded investments. You can buy an ETF in your brokerage account just as simply as you can buy shares in an individual listed company. One of the main advantages of being exchange-traded is that this provides ongoing liquidity in your ETF, even when markets are volatile. And then secondly, ETFs simply hold a basket of underlying investments that track an index. Using shares as an example, the benchmark for the Australian share market is the S&P ASX 200 index, which captures the aggregate performance of our 200 largest listed companies. Within that index, the exposure to individual companies matches the size of the company. So both the ASX 200 index and the ETF that follows it have their largest weights in household names such as the major banks, BHP, CSL and Woolworths. Beyond the benchmark index, there are then thousands of other ETF options that allow the investment committee to be more targeted and to fine-tune the exposures within your portfolio. This includes ETFs that track specific sectors such as healthcare, resources and technology, or if we see better value is available beyond our largest companies, we can choose ETFs that buy medium or smaller sized businesses. Then when we look overseas, there are plenty of options that provide exposure to specific countries and regions. We use ETFs to build portfolios because we accept the extensive research that shows managers who try and pick stocks to beat an index typically fail to do so on a sustained basis. We know that getting the asset allocation decisions right, including the sector, country and regional allocations, is the most important determinant of long-term portfolio outcomes. We think paying relatively high fees to active managers that typically provide less than the index return just doesn't make sense. And finally, we think it's important to hold a well-diversified portfolio, and ETFs are the most efficient way of delivering this. Investors really have voted with their feet over the last couple of decades, as ETFs have attracted trillions of dollars globally, much of which has come from traditional stock-picking managed funds. As one of the pioneers of the ETF industry said, you don't have to find the needle in the haystack when you can just buy the haystack. For more information, please head to implementedportfolios.com.au.